Okay, so let us start the session. So you'll know that I'll be ending a direct taxation subject. Okay. Under this subject, we'll see first of all what is the coverage part. So 30% theory and 70% problems. That means in your VTU examinations, you will be having from direct tax 30% theory and 70% of problems. Now, this direct taxation subject is divided into 6 modules. So you'll be having 6 units under direct taxation. Module 1 is basic concepts of income tax. Okay. I think you all have already done taxation, some basic part of it in your degree level. So now here little detail we will be seeing each chapter. So chapter 1 is basic concepts of income tax. Module 2 is income from salaries and house property. Module 3, income from head profits and gains from business and profession. Module 4, income under the head capital gains and income from other sources. Module 5, deductions from gross total income. And module 6, MAT provisions. Now, what is all this? All this I will be explaining when I deal particularly in that particular module. That module I will explain you in detail. So today, let us just concentrate on basic concepts of income tax. Module 1, basic concepts of income tax. Now, what all is covered under this module as per your VTU syllabus is, what are the basic concepts of taxation, different definitions, what is capital and revenue receipts and expenditures, what is the meaning of basis of charge and scope of total income, what is residential status and incidence of tax, what are the incomes which do not form part of total income, what is the meaning of tax planning, tax evasion and tax management. Remember students, as per your VTU syllabus, you have from this module problems only on residential status of individual SSC. That is point number D. You will have problems only on point number D, that is residential status, that too of an individual. Now, who is an individual? We will see who, like, what is the different types of persons and who is an individual. We will see in the succeeding slides. But remember, in this module, you have complete theory and you just have problems on the D point, that is residential status, and that too of an individual SSC. Rest, the entire chapter is a theory related chapter. So let us move ahead. Okay, so today we will be seeing, like in today's video lecture, we will be seeing what are the basic concepts and definitions, what is capital and revenue receipts and expenditures, what is basis of charge and scope of total income. Okay, now there are certain basic concepts that you need to know before we go in detail about taxation. So first of all, you all should know what meaning of tax. Now, tax is nothing but any amount that is collected by the government. Like it can be a fee that is collected by a government, a payment that is collected by a government. So government is the only authority who has the power to collect tax. So is it clear what is tax? Now, you must be thinking, why government collects tax? Why does government want tax? So for simple reason, government wants tax because for government, the source of revenue is only through tax. Now government wants revenue. Why does government wants revenue? Government wants revenue because for many reasons, because it provides free education. So from where it will provide free education to the children with the amount of tax. Then for the infrastructure, it requires amount. Then for healthcare, then for defense. So there are different facilities that are provided by the government to the citizens free of cost. Now, to provide those facilities, government wants some amount, some revenue. So that revenue or that amount is collected through the source of tax. Is it clear? Okay. Now let us understand what is direct tax and indirect. Tax is divided again into two types, that is direct tax and indirect tax. Now first let us understand what is direct tax. Direct tax is nothing but a tax that is directly paid by an individual who is earning income to the government. So direct tax is directly paid by the person who is giving the burden of tax directly to the government. What do you mean by direct tax? Now under direct tax we have income tax. Now what do you mean by that? Suppose I'm earning income. So on my income, I am going to pay tax to the government directly. So the burden of tax is directly on me and I'm directly paying my tax on my income to the government. So it is direct tax. Now what is indirect tax? Tax where the amount of money is going to reach the government not through me but indirectly through the shopkeeper. For example, when I procure any services or when I go to buy any goods, the shopkeeper collects the amount of tax from me and he pays the tax amount to the government. So actually it is me, the customer, who is paying the tax. But am I paying it directly to the government? No. I am paying it indirectly through the shopkeeper to the government. So it is a burden that is shifted to the consumer. So here in direct tax, the burden is on the person himself paying the tax. But on indirect tax, the burden is on a person who is indirectly paying the tax and the burden is shifted from the shopkeeper to the customer. Now, direct tax is progressive in nature. When I say direct tax is progressive in nature, what do you mean by this? It simply means that as and how my income increases. You all know the slab rates, right? Every year the slab rates are changed or they are kept fixed. So the slab rates are depending on your income. So as your income increases, your slab rate also increases. That is the rate of tax that you have to pay increases with increase in the income. So in case of direct tax, as and when your income increases, you have to pay more amount of tax. But in case, so it is called progressive in nature because it progresses as and when the uh, income increases, the tax that you have to pay on the income also increases. Now, what is indirect tax? Indirect tax is regressive in nature. Now, what do you mean by regressive? Like, irrespective it is rich, irrespective it is poor, everyone has to pay the same amount of tax. Suppose tomorrow I go and buy a cell phone from a shop and he charges me GST on the cell phone that I purchased. Now, can I tell I'm very poor, so I cannot pay you just lower the GST rate for me? No. Or can I tell I'm very rich, so you can charge a higher rate of GST to me? No. So irrespective of the consumer, whether is rich, poor, they have to pay the same amount of tax in case of indirect tax. So always remember, tax is a source of revenue for the government. Direct tax is directly paid by the person who's earning the income to the government. It is progressive in nature. Indirect tax is paid indirectly by the person through the shopkeeper to the government, and it is regressive in nature. Clear? Everyone has understood? Am I audible?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Okay.
Yes, ma'am.
Now let us understand this concept of what is Income Tax Act 1961. See, all these are the concepts which you all just need to understand. What does it mean? Okay, because this will be used again and again in the future modules. So what is Income Tax Act 1961? See, everyone knows what is income tax. Tax that you're paying on the income that you're going to earn. Now, for any tax, there has to be a levy, correct? So income tax is levied under some act which is called as Income Tax Act 1961. Simply government cannot charge tax. There has to be an act behind it to support the payment of tax. So Income Tax Act 1961 levies the income tax payable or paid by the particular individual. Now this act has many provisions, explanations, so many articles, so many sections. So it has totally 298 sections and 14 schedules. Now, what all does the act consist? Act consists nothing but an explanation as to what has to be done, okay, under income tax. Like how the income tax has to be calculated, what all falls under income tax, what all are the different provisions that has to be applied while calculating the income. So this act is nothing but a complete set of rules, provisions, all explanations, subsections, sections, which is going to help you to understand how to calculate the income. Next, Annual Finance Act. Now, everyone knows that every year, Feb 1st, the finance budget is being announced by the finance minister. Every year it happens. Now, that is nothing but a bill that is being presented in the parliament. Once you all know that the bill in a parliament is being approved, and once it receives the assent of president, that is once the president approves it, that bill becomes an act. So every year there is a annual finance act. Now you all know that in the budget, what do they announce? They announce maybe the changes in the slab rates, or maybe they announce some new benefits or advantages given to the farmers or in the agricultural sector, maybe in the infrastructure sector, defense sector. So the different changes that is going to be made in a particular year relating to the financial aspect is announced in the budget. So that bill is passed in the parliament. Once parliament approves that, then it receives the assent of president, and that becomes your, once that bill is approved by the president, that bill becomes a act, and that is Annual Finance Act. When I'm telling annual, means it is going to be yearly. Every year budget is announced by the finance minister. So annual means it happens every year. Next, income tax rules. Now, what are income tax rules? See, our complete subject is direct taxation. Now, there has to be someone to monitor direct taxation. So there is Central Board of Direct Taxation Committee, which heads the income tax, which administers the income tax act. So CBDT, it is called CBDT, Central Board of Direct Taxes, which administers the income tax. So they, from time to time, they will make certain rules. Act is there as it is, but rules are framed. Why are rules framed? So that there is a proper administration of the provisions of the act. So whatever rules are framed by the authority who is controlling the income tax, that is CBDT, Central Board of Direct Taxes, who is controlling, they will be framing the rules as and when required in order to have a proper administration of income tax act. And those rules together is nothing but the income tax rules. Next, let us understand what are circulars. Circulars are nothing but, they are again issued by whom? Central Board of Direct Taxes, because they are the one who has the power to administer the income tax. So Central Board of Direct Taxes will issue circulars. Now, why are circulars issued? Suppose in the act, what am I telling? Suppose in the act, if there is some ambiguity, if there is some doubt, if there is some clarification required, like suppose in the act something is written which is very absurd, which is very not able to understand what is it. So in order to provide a brief explanation about that, or in order to clarify the doubt relating to that particular provision which is mentioned in the act, they will issue a circular. Circular will give an explanation regarding clearance of doubt regarding a particular provision in the act. Circular will help the SSC, will help the assessing officer. Assessing officer is the person who will assess the income tax paid or payable by a particular individual. Circulars are nothing but issued by the CBDT, which helps in clearing the doubts regarding any provision in the Income Tax Act. Next is notification. What do you mean by notification, and who has the right to issue notification? Remember, students, notifications is issued by the central government, okay? And they are issued in order to give effect to a provision of an act. So notification is given, like in Income Tax Act, they may say that, suppose that minors are not liable to pay income tax. This is just an example. Suppose if the act it is written that minors are not liable to pay tax, notification that will be issued by the central government will give effect to that particular provision. Means notification will state that minors are not liable to pay tax from 1st August 2020. So notification is nothing but notifications are issued by the central government to give effect to the provision which is mentioned in the act. To just give effect to the provision, notifications are issued by the central government. Next is legal decisions. Many a times what happens is there is a fight between the SSC. Now I'll just, in my next slide, I'll explain you what is SSC. So now we just take, there's the person who's liable to pay tax. So suppose I'm liable to pay tax, and whatever tax I have paid, and the assessing officer who's going to determine whether the tax I have paid is correct or wrong. So whatever tax I have paid, and whatever the assessing officer, according to him, the tax that I've paid is not appropriate. So there is usually a misunderstanding or a fight between us. Assessing officer will say, pay more tax. I will say, no, I have paid correct tax. So if there is such dispute, and suppose if the SSC, that is me, I approach a High Court and then Supreme Court, and then suppose Supreme Court takes a particular decision in my favor, then that will be published in the particular site, that is income tax site. So that becomes a legal decision. Legal decision means decision taken by Supreme Court on certain affairs against which litigations were going on. Litigations means a dispute between the assessing officer and the SSC who is paying tax. So legal decisions are nothing but decisions taken by Supreme Court or maybe High Court in respect of a particular matter of a SSC. Now, is all these basic concepts clear, students? Did everyone understand these basic concepts?
Yes, ma'am.
Yes?
Yes, ma'am.
Okay. So let us move ahead. Now let us see certain basic definitions under income tax, which is very, very important because these definitions will be used again and again in your entire modules. So you all should know, you all should be very well versed with what does SSC means, assessment means, person, income, India, assessment year, previous year. This I'm talking only in respect to income tax, that's direct taxation. Okay. So let us see the first definition, SSC. Now, what is the meaning of SSC? Now, if I use the word SSC again and again in my succeeding sessions, you all should understand SSC is a person who is liable to pay tax to the government. SSC is the person who has to pay any sum of amount to the government. So everyone understood who is SSC? SSC is any person who is liable to pay any sum of money to the government. Now, who is what is the definition of assessment? Now, assessment means the procedure. See, SSC is a person who is liable to pay tax to the government. Assessment is the procedure that is being followed by the assessing officer. Now, who is assessing officer? You all know that in every particular city, there is an income tax office. In that income tax office, there are different assessing officer which will determine or check whether the tax that is paid by the SSE is correct or no. So assessment is nothing but the procedure that is followed by the assessing officer to determine whether the calculation of income done by the SSE is correct or no. Is this clear? Next, person. Now, when I say person under income tax, now who is a person under income tax? There are totally 7 people who fall under persons under income tax, and that is individual, HUF, company, there is AOP or BOI, artificial juridical person, local authority, okay, and a firm. So all these fall under the definition of a person. Now, who is an individual? Now let us individually see whatever 7 persons that I have mentioned fall under the definition of persons. Let us individually see whether you all know the meaning of them. Who is an individual? I and you are an individual. Individual is nothing but a male or a female is an individual. Individual is a minor, can be an individual. A person with unsound mind can be an individual. So individual is a single person. Either it can be a male or a female. It can be a minor, it can be a major. It can be a person of sound mind, it can be a person of unsound mind as an individual. Next I said is HUF. What is the meaning of HUF? HUF is nothing but Hindu undivided family. That is where the persons of the same family run the business under the Hindu Undivided Family Act. So Hindu Undivided Family, if they are running a business, that also is a person, and it is also called as an SSE, and they are liable for assessment. So it is not that only individuals are liable to pay tax. Remember, students, all the persons are liable to pay tax, because when I told you SSE, I said SSE is any person. Did I say any individual? No. I said any person who is liable to pay tax. So who all comes under persons? Individual, HUF. Next, company. What is a company? A company is either an Indian company. Indian company means the domestic company, or it is a foreign company. What is a foreign company? Company which is not domestic company. So either it is a company. Now next I said even a company is liable to pay tax, even a company is an SSE under income tax, and even a company is liable for assessment. Next I said is firm. Now what do you mean by firm? Partnership firm. Now do I need to explain what is partnership firm? Partnership firm means where 2 or more partners come together and they start a business. So even they are liable to pay tax, even they are SSE, and even they are liable for assessment under income tax. Next I said AOP or BOI. AOP stands for Association of Persons. What do you mean by Association of Persons? Where 2 or more persons come together for a common purpose to start a common business, maybe for a limited period of time, in order to have a goal of earning the profit. So even such association of persons are called SSE under income tax, and they are liable for assessment. Now BOI. BOI is a body of individuals. Body of individuals, they come together for a common purpose, and then they earn for a common goal to earn profits. And then they also are SSE who are liable for assessment. Now you all will have a doubt, ma'am, what is the difference between AOP and BOI? Remember students, AOP is Association of Persons, and under the definition of persons you have not only 1, you have 7. That is individual, AOP, BOI, company, firm, HUF, artificial juridical person, local authority. So it can be an association, like suppose HUF can get into a combination with individual and start a business, or maybe a partnership firm can get into a company and start a business. It is association of persons. When I say body of individuals, it is only individuals who are coming together to start a common business in order to earn the profit. So there is a difference, thin line difference between the both. Next is local authority. Now, what do you mean by local authority? Local authority can be either panchayats, it can be cantonment board, municipality. So, local authority is any authority that is again under the jurisdiction of the government. Next, I said is artificial juridical person. Now, what is artificial juridical person? Those who are not falling under the above. Above means individual, HUF, company, firm, AOP, BOI, local authority. They form under artificial juridical person means like idol, a deity. Suppose even Sai temple in Shirdi is liable for tax. Even Tirupati Balaji is liable to pay tax. So them under artificial juridical person, where there is a deity, there is an idol, okay, who is also an SSC under income tax, who is also a person under income tax, and he also will be liable for assessment. Next. Next, let us see what is the definition of income. See, students, in exam, you need not write the book definition, what I will be giving you all in the notes. Based on my explanation, if you all have understood, you all can frame it in your own words and you all can write, you all will still get marks. Provided you all are meaning the same, what does a particular person stands for. You can write it in your own words, provided you all have understood it and you all are writing it pertaining to this particular definition only. Next, income. What do you mean by income? See, in income tax, income does not have a proper definition. That means income can be anything which a person is going to receive or is received. So income is an inclusive definition. It is not an exhaustive definition. Exhaustive means like a particular definition is given and that is it. But income can include anything. That is why it is an inclusive definition. Income, salary can be an income. If you're earning any gains from your business, it can be an income. If you're winning from any lottery, it can be your income. If you're earning interest from bank deposits, your investments, it can be your income. If you're earning any money or gain from the sale of your property, house property, it can be your income. If you're receiving any rental income, if you have any property which you have given on rent, if you're receiving that rent, it can be your income. Dividends that you're receiving on shares, it can be your income. So income can be anything that a person is receiving. It is not a exhaustive definition, it is an inclusive one because income can mean anything that an individual is receiving. Again, next, India. Now, in Income Tax Act 1962 is applicable only to India. This Income Tax Act 1962 you cannot apply in US because it is applicable to only India. So it is very important for us to know what is the definition of India. So India means what? India means the Indian borders, the territorial waters. In the borders, you have waters, those territorial waters. You have continental shelf, exclusive economic zone. Now, in those territorial waters, below the water, there is a seabed level. That seabed level also is included in the definition of India. Then above that seabed level, there is airspace. So airspace above that also falls under the definition of India. So India means the borders of India, the territorial waters, the continental shelf, exclusive economic zone falls under the definition of India. The seabed also that is underlining those continental shelf, exclusive economic zone also forms part of India, and the airspace above those also form part of India. Next, assessment year. First, let me explain what is previous year. What is the meaning of previous year? See, financial year is a year comprising of 12 months, which begins from 1st April, okay, and ends on March of the succeeding year. So suppose now we say financial year is nothing but the previous year, which begins on 1st of April, which commences on 1st of April and ends on March of the next year. So suppose this year is 2020. So what is the financial year? It is nothing but April 2020 and it will end on March 2021. So it is called previous year. Previous year is nothing but the financial year. The year in which an individual earns income is the previous year. Next, assessment year. Assessment year is succeeding the previous year. When I say previous year is 2020, 2021, assessment year will be succeeding the previous year. That is, it will be 2021 to 2022. Now, what is the meaning of assessment year? Assessment year is the year in which the income which is earned in the previous year is assessed to tax. Remember, students, this is the golden rule of income tax, that any income earned in the financial year or previous year is always liable for tax or assessed to tax in the next year, in the assessment year. So income earned in the previous year, whatever income I am earning in from April 2020 to March 2021, whatever income I'll be earning during this period, I'll pay tax on that income, not in the same year. I will be paying tax on that income in the assessment year. And the assessment year is nothing but 2021 to 2022. So remember, assessment year is a year in which the income that is earned in the previous year is liable to tax, is assessed to tax, on which tax is paid. And previous year is a year in which you're just earning the income. And both comprise of period of 12 months. Assessment year is succeeding previous year, and previous year is your current financial year in which you're going to earn income. So did everyone understand the basic definitions of income tax? Yes?
Yes, ma'am.
Okay. Am I going too very slow?
No, ma'am.
No, ma'am.
Okay. So we have completed with what are the basic concepts of income tax, and we have also seen the different definition of income tax. Now the important thing, the next part is capital and revenue receipts. Now, even in your accounts that we have dealt first semester, you'll know that there is a difference between capital and revenue, or both means the same. No, there is a difference between capital and revenue. Now, what is the meaning of receipts? Receipt means anything that you're receiving. And expenditure means anything that is going out of your pocket. Any payment that you're making is an expenditure. So first, let us understand what is the difference between capital and revenue receipts. See, I'll read this later, whatever is there, but first just pay attention to what I'm saying. Remember, revenue receipts are always related to your operations of the business. Whatever income, see, receipts are nothing but inflow. Inflow is nothing but income. So whatever income you are getting from your operations of the business, from your primary, what is your primary source of business? From that, if you're receiving any sort of receipts, any sort of inflow, any sort of income, it is your revenue receipts. On other hand, capital receipts are those receipts which are not relating to your trading activity, which is not relating to your day-to-day primary source of earning income. So it is capital receipts. And revenue receipts is such a receipt that you will be receiving frequently. When I say frequently means again and again. Like in a year, it is not possible that you suppose if my business is to sell cell phones. I am dealing in selling. I have a showroom of mobile phones, and I'm selling cell phones. I'm not going to sell only one cell phone in a year, right? If my business is to sell cell phones, I am going to sell it almost like every month. I will be having sufficient amount of sales, sufficient amount of inflow. So my inflow is again happening again and again. So it becomes revenue receipts. That is, they are recurring in nature. Whereas capital receipts, when I say, suppose to run the cell phone, to run the business of cell phone, I have purchased a building. Now, when I purchase the building, when I purchase building, it becomes a capital asset for me. Am I going to sell that building every month and purchase the building and again start a showroom? No. So capital receipts are sale of your fixed assets, whatever fixed assets you've taken. Suppose I've taken a furniture, a particular showcase just to keep display all my cell phones. So when I'm selling those, I'm not going to, that is not my business of selling showcase, selling the furniture, selling the building. Those all are my capital assets. So when I sell my capital asset, it becomes my revenue receipts. Capital assets are sold only when the life of that particular asset comes to an end. Suppose there is a showcase in which I'm displaying the cell phones. That showcase, I will use it over a period of 5 to 6 years. Later, if it gets damaged, then I'm going to sell it. And when I sell it, whatever inflow I'm getting, I cannot say it is a revenue receipt. I have to say it is a capital receipt because I'm receiving not that money, not again and again, but once in a time after the use of a particular fixed asset. So I hope now you all have understood and you all can distinguish between what is a revenue receipt and what is a capital receipt. But I'll just read out this in case you all have doubts. Revenue receipts, it stems from operational sources. That is what I said, trading day-to-day activities. Capital receipts, it stems from non-operational sources. Non-operational means which you are not, like selling showcase is not your business. Selling cell phones is your business. So non-operational means which is not related to your day-to-day trading business. Revenue receipts, they are recurring in nature. When I say recurring in nature means those inflows you will be having in a particular year, again and again you will be receiving that amount. Capital receipts, they are not recurring in nature. Once in 5 months, once in 5 years. Means in a particular year, you will not be receiving that income again and again. Revenue receipts, an amount received on account of sale of trading goods or receipts in respect of circulating capital or flowing capital. This I've already discussed. What is circulating capital? That is working capital required for your day-to-day working of the business. So when I say day-to-day working of the business, it is nothing but relating to your day-to-day trading. On the other hand, capital receipts, when I say it is a receipt on account of sale of fixed assets. I've already discussed on this. Next, revenue receipts, an amount received by the way of substitution or addition of an income is a revenue receipt. Now, addition of an, what do you mean by this? This means that revenue receipt can be a receipt that is received by a way of substitution of an income. Now, what do you mean by that? Let's give an example. Suppose I have taken a particular company. I'm a company and I have taken a particular film, movie, and I said I am going to release that movie. So the releasing authority is taken up by my company, provided with a condition that none other company should release that particular movie exception me. So only I have the right to release that movie. So I have entered into a contract as a company. Now later someone else some other company has already released that movie. Now since I had entered into an agreement and that agreement has got breached, that other company has to pay me compensation. So that compensation is nothing but substitution of an income which I could have received if I could have sold this movie alone. If I could have released this movie alone, I could have earned my profits. So whatever profits I was supposed to earn, I'm earning it, still earning it by the way of compensation from that other company, because that right of me alone releasing that particular film, movie, is got breached. That is the reason. So substitution of an income also can be a revenue receipt. On the other hand, capital receipt is amount received in replacement of a source of income is a capital receipt. Suppose it is just an example, replacement of a source. I'm working in Jain College of Engineering and I decide that I want to terminate my services. So I just go tomorrow and just inform principal I want to terminate the services. So as an employee, if employee immediately terminates, he has to pay compensation. So principal says you have to pay such and so amount because you're leaving it without a prior notice. So whatever compensation Jain College will be receiving from me, it is a capital receipt for Jain College, not a revenue receipt, because it is a replacement of source of income. Because tomorrow, when I'll not be working, they will have to appoint someone else. So I'm terminating my services. So for termination of services, whatever income will be received by the college, it is going to be a capital receipt for the college. So have you all understood the difference between revenue receipt and capital receipts? These are just the parameters based on which you can identify whether a particular receipt is a revenue receipt or a capital receipt. So have you all understood this particular slide? Yes, students?
Yes, yes, ma'am. Understood.
Okay. Moving ahead, what is the capital and revenue expenditures? On the same line, as we have seen what is capital and revenue receipts, on the same line lies the expenditure. But expenditure is something where there is an outflow of money, where there is an of money, where there is something where which is going to be out of your pocket, something that is not going to go inside your pocket, but something that is out of your pocket. Nothing but expenditure. Now, how to differentiate what is revenue expenditure and capital expenditure? So, on the same lines, let us see timing. Revenue expenditure are charged to expense in the current period or shortly thereafter. For example, revenue expenditures are expenditures that happen regularly, that happen again and again, that are recurring in nature. As capital expenditures are those expenditures that happen over a longer period of time. For example, now electricity bill. Suppose I'm running a business. I need to pay electricity bill. I need to pay electricity bill. I need to pay salaries. I need to pay for stationaries. I need to pay for my stock items. So all these expenditures are monthly expenditures or maybe quarterly expenditures, which I'm going to charge as an expense in the current period only. So it is revenue expenditure. But suppose if I'm purchasing a fixed asset, am I going to purchase fixed asset every month? Every month? Am I going to purchase a chairs every month? Am I going to purchase furniture every month? No. So whatever expenditures I'm making on my fixed assets or capital assets, I'm not going to charge the entire expense in 1 year only. If you all have seen, the expenses gradually charged the form of depreciation, little amount of it is charged every year. So capital expenditure, the expenditure is not charged together to the P&L, it is charged gradually. But revenue expenditure, the complete amount is charged, 100% amount is charged to the P&L account. Next, consumption. A revenue expenditure is consumed or assumed to be consumed within a very short period of time. Obviously, whatever staff is working in the organization, their services are consumed in the same month. Correct, very for short period. Electricity, what are you using? You're using for a particular month. So whatever expenditures you're making in respect of revenue expenditures, they're consumed within a very short period of time. Whereas capital expenditure, you will consume that particular asset for a longer period of time up to the life of the asset. Till the asset can work, you're going to use that particular uh, asset, and that is capital expenditure is an expenditure on which you will use it. You will use such expenditure over a life of the fixed asset. Next is size. Revenue expenditure are smaller expenditures, like the amount is very small. It is not a huge amount, whereas capital expenditures usually are having a monetary amount which is very material or which is very larger in size. So the amount involved in case of capital expenditure is high, huge. So with this, we have completed the what is revenue and capital receipts and what is the revenue and capital expenditures. The next part what I wanted to cover in today's session was the basis of charge and scope of total income. But we have already like only 5 minutes are left, and this at least requires minimum 20 minutes for explanation. So this we will cover in our tomorrow's session. So thank you, students.